Hey, Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. I want to touch briefly on an update with the Canadian housing market. I'll be releasing a video later this week with John Pasalis where we do our regular monthly deep dive on the Vancouver and Toronto housing markets. So obviously be sure to check that out. But I want to sort of highlight some important points, which is John and I have been doing these interviews, a lot of them together for many, many years, a lot of them to several institutions, being on sort of private webinars back in the day. And we always talked about, like, it's all about, in the Canadian housing market, it's all about leverage, it's all about debt. And what we really have to watch for, if you ever have that trigger event, is where are interest rates? And that's really going to tell you the Canadian housing story. And so I always said at the beginning, towards the middle of last year, end of last year, and there's some early discussions around interest rate hikes and whatnot. But I said, so long as when rates get north of 3.5%, that's when you'll start to have troubles in the housing market, because we already saw that in 2018. So it really wasn't hard of like a prediction. It was just like, listen, like, run the numbers in a mortgage calculator and that will sort of tell you the path for the Canadian housing market. And so, now that you've got your variable rates north of 4%, you've got your 5-year fixed rates north of 5%, it's pretty obvious to see that was going to create some pain in the nation's housing market. And so if we look at the data here in Vancouver, Greater Vancouver just registered a 22-year low in home sales in the month of July, and I suspect that's going to continue again in August. And so it's no question that prices are coming down. In fact, the home price index is now down 4.5% from peak. Obviously, this is a lagging indicator, guys. If you're actually in the market, it depends where you're looking, what you're buying, what you're selling. But basically, if you go out in the suburbs, you're looking for a detached house. Your typical detached house further out in the suburbs is down, I would say conservatively, 15% is a fair number to pick. Again, you really have to look and start running comps. You can't use a median price, you can't use an average price, and you certainly can't use a benchmark index in a highly volatile, illiquid housing market. None of those metrics are telling you in real time where the market's at. And so, it's a similar thing. Now, if you come closer to the inner city, condos on the west side of Vancouver, where I typically tend to operate, you're looking at, say, a 5% discount from peak in February. But those also didn't have huge increases. So basically, wherever the most of the froth was during the pandemic, that's where you're seeing now the largest correction. And like, everybody knew that the suburbs, which basically had doubled in 3 years, was ripe for a significant correction, regardless of what happened with interest rates. It's just the fact that you've got a doubling of interest rates in the last 4 to 5 months. It's only exacerbated the speed and the magnitude of the housing correction. And the same thing is basically happening in Toronto, just, I would say, at a greater level. Greater Toronto area home sales had just recorded 20-year lows in home sales for 3 consecutive months. So again, this is not 1 month of data. This is 3 consecutive months of 20-plus year low in home sales. That's not adjusting for the record population growth, the increase of housing stock across Toronto, right? I mean, part of the whole bull case for the Greater Toronto area was that people were migrating into Toronto, that there was this economic boom that was happening, and the record population growth. So when you say, well, you've got a 20-year low in home sales, not adjusting for the amount of people that have grown over the past 2 decades, really tells you the whole story. And so, the home price index, which again, smoothed out lagging indicator, that's showing a 3.9%, 4% decline essentially in 1 month. Month over month, it's very, very rare to see a 4% decline. Again, if you assume prices drop 4% a month for the next 12 months, I mean, you guys are pretty smart. You can run the numbers on that. But so far, year to date, the GTA home prices have corrected 13% off peak. So that's a very, very fast correction. And, now everyone's got, obviously, all these grand predictions where the housing market's going to go. The big crash is finally here. Like, listen, guys, I've been running this channel since 2015, 16. You guys know that I've always been talking about the amount of household indebtedness in the Canadian economy and in the housing market, which has basically underpinned these valuations. I've always flagged that as a risk. So it's something that I am deeply concerned about. But the trajectory here moving forward is going to come down to the role of basically what is going to happen with inflation, commodities, geopolitics, to suggest that anyone has a firm grasp on what's going to happen in these three sectors. This is a highly uncertain environment. And in fact, I think central bankers, despite the confidence that they exude on public television, are completely guessing about what the next move is and how they're going to tackle this and how far interest rates are going to go or when they're going to reverse course. These guys have no idea. Listen, they missed the whole inflation picture over the last 18 months, and now we're talking about the next move forward and on inflation and interest rates. This is a total guess. These guys have never navigated a situation where you're at the end of this long-term debt super cycle. You've got global, not just Canadian, global debt to GDP at 365%. And now you must raise interest rates to combat inflation. So the question is really, how does this all play out? I mean, what's happening right now in the bond market and the commodity market, both are telling us that inflation is going to roll over, and both are implying a pivot from central banks. However, the rhetoric from central banks and the labor market is telling us right now statistically something else, which is inflation is going to be more persistent. So you're seeing that in wage growth coming through. You're seeing that in inflation numbers obviously being sticky. Now again, the question is, which one is right? Are the commodity and bond markets correct? Or is the labor market and the central bankers correct? And this is going to take some time to come off. That's really the question. So long as rates in Canada stay at 5% or 4.5%, 4.4%, 4.3%, you're going to continue to see softness and weakening in the Canadian housing market. There's simply too much debt. House prices, when you simply run the numbers, we talked about it in last week's episode, that if you take a mortgage at 2.5% versus today it's at 5%, and you assume 20% down, 30-year amortization, in order to have equivalent payments, the price of the home needs to decline by 25% in order to offset the doubling of the mortgage rate from 2.5% to 5%. And so this is the dilemma that we have here. I'm not going to be able to tell you guys today where inflation is going to be 6, 12, 18 months from now. All I can tell you is this is the predicament that we have. The outlook is extremely negative. It's hard to imagine the setup being a whole lot worse. But all I can tell you is in the next 3 to 4 months, I don't see any of this changing. I think that you're going to be stuck with persistently high inflation. Central banks are always slow to pivot. So despite what the commodity and the bond markets are telling us, that suggests inflation is going to roll over because the central bankers are plunging us into a recession, that inflation, that they still might push through. And so one of the key things I'll kind of point you to is some recent commentary from the Bank of England. The Bank of England came out this past week. They raised interest rates by 50 basis points. And what was more interesting was the commentary from the Bank of England governor, where he says, listen, England is going to enter a recession in Q4 of this year, and it's going to last well into 2023, saying that this recession in England is not going to be as deep as the global financial crisis in 2008, but is going to be probably as long as that recession was. So, I mean, those are pretty stark words from a central banker to say. Very rare do you hear a central banker say, hey, we're gonna have a recession and it's gonna be a pretty bad one, but we're going to have to do this because the alternative of keeping inflation high is worse. So again, we're going to have to wait and see how this all plays out, because at the end of the day, historically over the past 10, 20 years, central bankers have always pivoted in the eyes of deteriorating economic conditions. But as of right now, they are coming out forcefully and telling you that we aren't going to pivot despite the fact that we're going to be entering a recession. We have to get inflation down. So I think the next question is at what point does this trigger a financial crisis type of event? I think it's pretty obvious to look around the world and say, holy smokes, there's a lot happening in the world right now. You've got the war going on in Ukraine. You've got, escalation in Taiwan. You've got the Chinese property bubble, which looks like that's on the brink. You've got the U.S. dollar strengthening at an incredible pace, which is destroying emerging markets. You've got the Japanese yen falling to 20-year lows against the U.S. dollar. You've got Europe, which is implementing anti-fragmentation tools because spreads are blowing out on Italian debt versus German debt. There is so much happening. And so for me to sit here and say, hey, guys, this is exactly what's going to happen 6 months, 8 months, 12 months from now, I think is naive. I think that the smartest people in the room, I read a lot of research. I get a lot of research that's sent to me, some of the smartest thinkers, I think, in the world. And the divergence of views of how central banks are going to react and what's going to happen into inflation and when inflation is going to roll over and how quickly, there is no consensus right now. There are two incredibly smart people on both sides arguing about how this is going to play out. So all I can tell you is if you're looking for the answer on the Canadian housing front, if you're trying to get a sense of when does this end, when does this get better, all you have to do is watch basically the inflation, the central banker policy moves, and the economy. So all I can tell you is so long as mortgage rates stay where they are, you're going to continue to have more pain. And that's really what I'm working for. And I think one of the things I'd like to point you towards next is the brilliant report that I read many, many years ago. It's called Housing is the Business Cycle. And sort of the notion behind that was basically like, listen, housing plays such a key financial component in everybody's life. Okay, so whether you own or you rent, like housing is basically pretty much for most people your number one expense. It's typically for a lot of most people, it's your largest asset as well. And so when that asset becomes illiquid and starts to decline in value, there's that wealth effect where people start to clench up and start to get more conservative with consumer spending, etc. So housing is typically a very good leading indicator for the economic knock-on effects moving forward. And I think one of the ones, like I'll point to you guys here, is like, I'm in Vancouver. There's a furniture company called Article. They're one of the largest online furniture retailers actually in Canada now. They just announced a 17% reduction in their labor force. Okay, that is not a small reduction, a 17% labor force. And you actually read the comments from the CEO. He says, listen, we had a huge drive up during the pandemic. Demand has tapered significantly, and we're now overstaffed, and we have to clean up our balance sheet. And so we've got to lay off 17% of our workforce. Well, let me unpack that for you. He talks about COVID and pent-up demand. What happened was his company, like the housing market, was artificially inflated by cheap and abundant credit. When you have back-to-back years of record home sales across the nation, what happens when people buy out? What happens when people transact new housing? When you are moving to a new house or you're selling a house and downsizing and going renting a new place, you typically are buying new furniture to furnish that place. You get a bigger house, it means you need to get a bigger couch. And so they obviously benefited tremendously from that housing boom. And now that, again, 20-year lows in Vancouver and Toronto, the two largest metros in Canada, it's no coincidence that knock-on effect that nobody's buying couches anymore because the housing market is at a standstill. And you can play this on for all sorts of different things, renovations, hey, your house goes up by $100,000 that year, refinance it, go buy a boat, get a new car, go on vacation, pay off some other credit card debt. So the knock-on effects, housing is the business cycle, whether you like it or not. Housing is a very, very strong leading indicator. In fact, there's the reason why some of the leading economic institutions in terms of research will actually look at residential housing permits in order to get a forward-looking indicator, right? Like if you are in the process of obtaining a permit, it probably indicates to you that you're feeling good about the economic situation, that you're going to get a permit and begin construction on a new home or a renovation. And so when those permits start to decline, that's usually an indicator that the economy will begin to follow suit. So that's kind of what I'm watching. Again, certainly not perfect, trying to figure this out just like everybody else that's watching this channel. I'll continue to give you guys my inside scoops on what's happening locally in these housing markets. But I think from a bigger picture perspective, I'm trying to figure this out just like everybody else, which is how is the data going to play out? How is this going to work its way through the system? And how are central banks, more importantly, going to determine, and how is the bond market going to determine this economic data and this inflation data moving forward? So, as always, hope that helped. See you next week.